Hello everybody, my name is Bob Klefsis, President of All-Star Financial. I want to welcome you to the first quarter 2014 All-Star Financial Quarterly Review webinar. Our title this year for our newsletter as well as our webinar is Cautious with a Cash Cushion, and we'll talk about why we believe that cash cushion that we've put into your portfolios will be beneficial. Bob's Corner is talking about some of the money myths programming that we've done on WCCO, and we've had such a great response to that people want more. We decided to put together a seminar that's really going to help dispel and continue to dispel those myths created by the big brokerage houses. We're going to talk about the who, the how, and the why of All-Star Financial within the seminars. We're going to answer the questions of, where are we economically? Is the market overpriced? The dates on those are on April 17th and 29th at 7 p.m. and then May 20th and 31st at 7 and 9:30 in the morning. That's a Tuesday, Thursday, and a Tuesday, Saturday. So please invite your neighbors, friends, family. For those of you who are clients, those of you who are prospective, we'd love to have you there. Remember, again, as clients, if you were to bring in somebody from a referral and an invitee to one of our seminars that becomes a client, that helps to reduce your fee potentially. I want to talk a little bit about the market overview first of all. There's a lot of improvement at the end of, or a lot of movement, excuse me, at the end of 2014 when it was really positive, 2013 when it was really positive. But we really have the winds of caution have kind of blown into our sales, with projected earnings being scaled back, weaker economic data on overall coming out, signs of China slowing down. They're making an internal transition from an export nation to a consumer-driven, self-sufficient nation. We have 15 to 20% of your money in cash at this point because of that, and we believe that anticipated slowdown is a result of business spending still being fairly low. Housing and vehicle sales are off, in addition to the China and crisis in the Ukraine. So when you look at risk and volatility, it doesn't have to be bad. It can create opportunities, and we really think that the opportunities value right now are overseas. So good to have cash. When we look at the U.S. economy, frosty start to the 2014 season, literally. Indicators really weakened in the first quarter. We saw the GDP was down to 2.6 on Q4, down from 4.1 on Q3. Housing and jobs have leveled off. Manufacturing and service sector indexes have both fallen, and unemployment is really stuck at a 6.5% to 7% rate. A lot of people are blaming it on the harsh winter season that we've had. I'm not sure that that's necessarily the case. I think that's probably some of it. On the positive side, however, we're at record levels of cash in businesses, so we should anticipate the M&A activity fairly robust here in the near future. And then tax revenue has increased. With our tax changes, deficit has been reduced. So there are some positives out there, but again, a frosty start for the most part. When we look at the U.S. economy going forward, we think things should improve with the weather, as I mentioned, but the GDP for the first quarter is probably going to be around 2.0. So it's going to go from 4.1 Q3, 2.6 to probably 2.0. Not the direction that we want, particularly as the Fed is reducing the bond purchases. Now, reducing the bond purchases should be saying that, hey, the economy is doing pretty well. I'm not sure that that's the case. I think it's a little too early. They've removed the unemployment and inflation targets to these dollars. Not everybody knows this, but the unemployment numbers they had marked at 6.5%. They really had to stop the quantitative easing. They're almost there right now. And inflation, if it was over 2.5%, whichever came first. They've taken those quantitative numbers off the table and now put qualitative, which I think is going to lead to QE infinity, where the qualitative decision is basically at their whim. So the key is still unemployment. I just don't understand why we can't get to where we want. College grads, the unemployment has dropped, however, so that's a good sign. But we've got a long ways to go. Business spending is still way below what it should be. When we look at the bond market and see how interest rates have gone up and down over the last year, interest rates retreated again. They went from about 2.9 to 2.6. Money flowed back into bonds as a result, and the bonds had a fairly decent quarter after having a negative quarter, fourth quarter of 2014. They ended up positive somewhere between 1.5 to 5%. High quality bonds performed pretty well. Long-term government bonds and corporate bonds were up 5 to 6. The high yields, domestic up a little bit less than that at 2.5 to 3, and global less than that at only about 2 to 2.5. Part of that reason was the emerging markets took a little bit of a hit also because of the Russia and Brazil downgrades in their bond portfolios. So emerging was only up about 0.5 to 1.0. But again, those global bonds are going to come to play huge in our asset allocation, which I'll explain. So when we look at bonds going forward, we think the trend in the near term is really to look at lower, but in the long term, definitely higher. We think you have to take cautious approach with that. Shorter duration is always good. The floating rate bonds that we have in your portfolio obviously are going to help. And then to diversifying globally. Good example would be when our market was down about 6.5% in January, the global bonds were up. And that's an inversely correlated asset that really helped us and will help us. Our current bond portfolio is all of these. Like I said, global bonds helped in the first quarter. Remember that insurance theme that we talked about last quarter. Domestic stocks, when you look at the domestic stock market, the U.S. led the way again relative to the international markets. The U.S. indices saw that the broad market was up a little under 2%. Russell 3000 value stocks outperformed growth 3 to 1 after growth outperforming value last quarter. Large outperformed small about 2 to 1 again after small caps being better last quarter. So which begs the question, is the small cap arena undervalued or is it overvalued? And we believe it's probably a little bit overvalued at this point. Leading sectors also kind of flip-flopped this last quarter. Utilities were up 9.6. Healthcare was up 5.4 after both being negative last quarter. And then this quarter our losing sectors, or the sectors that didn't perform quite as well, were the best ones last quarter, and that's consumer discretionary was negative 2.4, which again doesn't bode well for the economy, and industrial stocks basically broke even. Looking forward on the domestic stock market, most firms are still really cautious on their spending, and that spending includes capital as well as employment capital. Even though we're really at all-time record highs for corporate profits, margins, cash levels, we're still seeing that caution in the wind. Growth projected is to slow from about 11 to 8% year over year, so we're still growing, but growing at a slower pace. And that really begs the question, after a 5-year bull market, is the market a little bit overvalued? When we look at the international markets, we look at the risks that abound. That's why they've lagged. When we look at Europe, Europe was slightly up at about 2.3 this last quarter. Japan was negative 6. China still struggles. Again, they're from a financial and credit reforms at minus 8% for the quarter, yet their valuations are screaming good. Emerging markets were down 2.4 after being down 2.6 in the fourth quarter, so a full 5% the last 6 months, when they probably have the strongest fundamentals that we've seen in all of the choices that we have. And again, political change in Venezuela, Turkey, Thailand, the social political problems that they have there have created kind of an influx of risk parameters that people don't like right now. But believe me, they will be a screaming buy when those things go out of the sales. International markets looking forward, again, current events are holding the markets back, which we think is momentarily. Russia versus Ukraine, is that a big deal? Yes, but not as big a deal as maybe Iran and Iraq and Israel. But China, again, consumer transition, that domestic consumer transition they're trying to make from being an export nation to a consumer nation that's basically supplying their own economics by buying internally. And even though the foreign markets are more volatile, you have to remember there's three key advantages of having international investments. Today, more than 50% of our capital in the world is global. It's non-US, right? So those global markets still own the majority of the equities. So we need to be there. They're significantly undervalued, again, because of those risks that we've talked about that are what we believe to be temporary risks. And for the first time in about 4 years, we've seen diversification to the U.S. market to establish itself in a negative standpoint from a correlation standpoint. So we've seen the domestic markets go up and the internationals down, and when the domestics are down, internationals are up. So that's going to bring, I think, really good value to the table. In summary, are we going to have a thaw in the economy? The questions that we have is, will spring weather help? Will the headline risks fade? Will we see better economic signs? Those are all important questions to answer. Diversification is still the key. When we talk about volatility through 2014, it's not going to go away because these uncertainties aren't going to go away. Our debt's not going to go away. All-star performers have helped, though. When we look at PIMCO Income Manager of the Year, Conestoga Capital Manager of the Year for 2013 in their categories, and the Market Vectors Wide Moat that we have, and Double Line Emerging Fund is in the top 10% of its peer group. What does diversification look like to me is in our newsletter, our 5th page of our newsletter, and really we want to talk to you about the fact that there's a lot of risks out there. Diversification is important. You have interest rate risk, you have market risk, you have sequence risk, longevity risk, currency risk, socio-political risk, we can go on and on. But the fact is that we want to really figure out what is the best diversification for you within all of those levels of risk and parameters of risk. So we want to simplify, and we'd really like you to read this 5th page. It's really a balance of the 3 characteristics of risk, and that is the risk tolerance. How much risk from a personality profile can you afford? There's a balance between risk tolerance and risk capacity. How much do you have to take from a standpoint of being able to accomplish your goals and objectives? From a risk required, again, capacity and risk required is fairly similar. So find the right balance is really the key. We think that if you're not visiting with us this quarter, call. We'd love to help define what we believe to be your right level of risk. We have our sophisticated risk tolerance questionnaires, etc., that can continue to help. If you're not meeting with us and you feel vulnerable, please give us a call. But just for fun, at the back of our newsletter, we always look at a restaurant recommendation. Casetas has always been a great place in St. Paul. And now they have the rooftop dining up there, that the weather's getting better. Recipe came from our teammate Lisa's family recipe, grilled chicken and berry salad. Read the recipe. I tried it last night. It's awesome. And the quote of the quarter, as is the spring season enters here, along with the baseball season, Babe Ruth said eloquently, yesterday's home runs don't win today's games. Don't look through your rearview mirror, look through your front windshield when you're making investment decisions. And really that's what we believe to be where we're at right now, where the market over a 5-year bull market has gotten a little bit frothy. Don't look behind you expecting the same thing. Look in front of you to expect probably a little bit more volatility. Again, we want to thank all of you for your continued trust in the All-Star Financial team. Remember, our referral program can reduce your fee. Our seminars, again, are a great way. We're going to have hors d'oeuvres and wine and refreshments for you. We'd love to be able to see 1 or 2 of your friends, neighbors come and really see what All-Star Financial can do for you. Again, contact information. Do not hesitate to call any of the team members here. we'd love to be able to help you out. So in closing, thank you for, again, trusting All-Star Financial with your assets. If you are a potential client, please give us a call. We'd love to be able to sit down with you. Have a great day, everybody.